Hi guys, welcome to my channel. In today's video, I'm going to talk about how I am building my US portfolio from the scratch. As you are aware, over the last few months, the Indian market hasn't been working to its best potential. All the major indices are down. And as we move forward in the history, you will see that investing in only one market, while sometimes it can be very lucky, but it can also be very risky during period of downturn. So I'm going to show you with data point as to why you should consider diversifying a part of your portfolio outside of India to the US market. So without wasting any time, let's quickly dive into today's video. So the goal that I have for today that I will be defining and I will talking to you about a particular framework that will help you to start the US portfolio from the scratch, wherein the first goal that I have for you is by the end of this month, we will invest 5,000 USD. By the end of next month, we'll invest about 10,000 USD. And by the end of third month, which is June 30th, I will invest $20,000 with you. And I will show you in this channel that how my portfolio is growing. So I'll walk you through step by step with rational, with data point, with exact logic as to why I invest in those shares. But before we proceed, one quick disclaimer. This video is only for education purpose, okay? Please consult your financial advisor before investing your money into any stock. Buy nothing, do nothing, click nothing, just here with me. Now, the question that comes that why should Indian investors look beyond the local market? The first and the most important reason are the things in red. So Nifty 50, Nifty 500, Nifty Mid Cap 100, Small Cap, Micro Cap, all the major indices are down. And this is not one or two stocks. These are indices. It's a collection or a basket of 50 to 500 stocks, and all are down. But on the contrary, if you see the only two things in white are the S&P and the NASDAQ, and along with that, the gold and the silver. So from here, you understand a blend of all these asset classes is the best way forward. Now, the question that comes that why US? What is it that US market offers which the other market does not offer? So as you can see over here, the first and the most important reason is the global dominance. So what I mean by global dominance? So global dominance means that you are not just buying any technical or technological stocks, right? You're actually buying companies with a worth 3 4 trillion dollars. So just to give you a bit of context, that's the entire GDP of one particular country, right? So that is how big these companies are, and that is where you see there's so much of expansion, right? So these are all global dominance because they have been able to build a great moat for themselves. They have a huge competitive advantage, which a new company will not be able to come and disrupt that space. The next important option is the currency hedge. What I mean by currency hedge is that the US market is traded in USD, and USD is alternate currency, unlike INR. And as most of the global trade happens in USD, it offers a good currency hedge against your falling INR. The third and the most important reason is a fractional investing, which means that unlike India, wherein you need to buy at least one share of a company, that is the unit stock, US market offers a very unique thing in fractional investing. So you can buy zero point 0.5 stocks of Google, or you can buy zero point 0.1 stock of Google, right? So any denomination is fine. It offers fractional investing. The fourth reason is a geographic diversification. What is geographic diversification means that if you pull in all your money in the market, and if there is a war, there is a conflict, there's some kind of civil unrest, there's something to do with politics, whatever that can be the reason, right? Your entire pool of money, your hard-earned pool of money, is only tied to one particular country. If the country doesn't move forward, your money doesn't move forward. So if you invest about 10% of your portfolio in the US, whatever happens, that is a good hedge against the 90% of the portfolio that already is in the Indian local markets. The fifth option is a market maturity. Market maturity means it offers more liquidity, right? There's too much of buy and sell that happens in the US, so it's a very matured market, right? In that way, uh, and the fourth and and the last, which is the sixth point, is the innovation premium. So innovation premium, meaning that all the innovative thing that happens, which is about AI, which is about software, about computers, the internet, the social media. All the innovation that you talk about in the last 20 years have actually started from the US, and then it slowly cascaded to the entire world. So innovation premium is very, very high in the US, and that is why US offers a very, very good blend of global dominance, the currency hedge, the fractional investing, the geographic diversification, market maturity, and the innovation premium. Now that if you, in case you're convinced that you want to start a portfolio in the US, how to go about building it? So there's some steps that can is involved. The stage one is basically when you are just starting in the to explore the US market. So as usual, you should start first by exploring a basket of stocks, which is the indices. So you can consider buying the Invesco NASDAQ 100 ETF, which is called the QQQ ticker symbol. That is the ETF that offers a good basket of 100 NASDAQ technological companies. If you are a stage two, which means you have explored at least you are 1 month or 2 months into the US investing, then you can consider a magnificent seven stocks as well as non-tech to provide a good blend of technical as well as non-technical part of your portfolio. The stage three is where you can consider max 7 stock with that of mid cap and small cap, right? And in the stage four, wherein you are a pretty much a pro investor, you know exactly, you have a high conviction, and you see one of the stock is about down 20, 30, 40%, and that is where you can do some contra bet with the goal that in case it reaches its all-time high, there's a good amount of money that can be made. So if I tell you about something that I am adding to my wish list, and I feel that in the next couple of days I will build a strong position in that company, that is Microsoft, uh, because it is already down about 25-30%, and I feel it has a very, very high competitive advantage. So that is a swing trading that I am willing to take. Now, maybe you are feeling that okay, US portfolio is good, but is now a good time? Because slowly we are seeing India market to already start recovering, right? Now let me show you some data point between the top seven Nifty companies and the Max 7 companies, right? Now, I'm not talking about the market capitalization or how big it is. Let's talk about something very, very basic, which is about operating profit margin, which is how much margin their businesses have. Now, if you look at the Indian companies, the best about among them is Airtel, which has a 50% operating margin. But rest, if you see, the margins are very tight. So if the margins are tight, means any uncertainty about rate cut, right, uh, or political unrest or any kind of conflict, right, it is very much susceptible to any of these risk elements. However, a 40, 50, 60% margin offers you a good cushion, which means they have such a big competitive advantage that macro or micro, they are a bulletproof against those. Now let's look at the return on equity. Most of the Indian stocks are in red, barring one, which is TCS. And in US, all the seven companies, all the six companies are in green, barring one, which is Tesla. Now look at the PE with respect to growth to understand that is their PE justified with regards to the growth that they have. And even if you see, I think there is a good, not discounting, maybe a discounting is in terms of Nvidia in terms of PEG less than 1%, and Meta. But outside of that, if you look at all the stocks, barring Tesla, everybody's peg is pretty much okay, which means they have their PE is justified with the growth that they have. And if I look at the operating profit margin, it definitely is worth your consideration. So let me now show you how I have started building my position by investing $5,000, right? So this is my portfolio as on yesterday. You see that is my name, and I have just blurred out the Drive Wealth ID, which is associated with Vested. This is I use Vested, but for you guys, you can choose any broker that you feel is right. I have no recommendation for you. You can consult your financial advisor for that. I'm not selling anything to you guys, but I generally use Vested and I like it. Okay, so if you look over there, I have invested about 5,123, and currently it's at 5752, which is a 13% profit. And if I look at the XIR, which is compounded like internal rate of return adjusted, basically it means that from the day I started investing in one particular company to an year from then, I am about a 15% XIRR, which is much higher than most of the Indian mutual fund that you guys own. Okay, so this slight diversification offers you a good hedge. Now let me break it down with the stocks that I own. On the right hand side, you can see a stock wise allocation as well. I only have 10 stocks. This is a very concentrated portfolio that I'm managing because I'm super confident in the companies that I'm investing. So, so Google, Amazon, Meta, Microsoft, these four companies along with Uber, right? They have about my good 70% of my portfolio is in five companies, right? So 2020 is Amazon and Google, and rest you can consider 10 Meta, Microsoft, and Uber, right? Uh, so good 70% is over there. Palantir and Nvidia is about 8%. That's about my 85%, and rest I have two, three small companies. So that's about my portfolio, guys. In the next video, which is a follow up to this video, I am going to show you that how I am going to increase my total investment from 5,000 to that of 10,000 USD, which is about 1 month from now, and hopefully by then I should be at a XIRR of minimum of 18%. So stay tuned. I'm going to show you my portfolio yet again, and I'm going to tell you why did I buy that particular stock and what are the stocks that I churned out from my portfolio. Until then, thank you so much for watching. In case you guys have got some value from this video, I would highly recommend you to click on that like button and do subscribe for more such insightful videos. Thank you so much for watching. See you the next time.